Welcome to This Explainer. Today, we are diving straight into the actual mechanics of wealth. Specifically, we're going to break down how assets generate passive income, and trust me, this might completely change how you view your bank account. So, most of us grew up hearing the exact same advice, right? Get a good job, work incredibly hard, and try to earn a higher salary. But the source material we're looking at today fundamentally flips that entire narrative on its head. It suggests that true wealth actually isn't about how much you earn from your labor, but how much you can make your money make for you. And we can really start unpacking that with a pretty revealing, maybe even slightly uncomfortable question. If you just stopped working today, from where would money flow into your pocket? For most people, the answer is nowhere. The money just stops. It exposes the dangerous trap of relying solely on earned income, which is precisely why you see so many high earners still living paycheck to paycheck. They're trading their time for money, meaning their income has a hard, absolute ceiling that's totally dependent on their daily grind. Okay, so how do we escape that trap? Well, the source material suggests a massive paradigm shift. Robert Kiyosaki simplifies this in Rich Dad, Poor Dad with these brilliantly straightforward definitions, and they're based entirely on cash flow. An asset is simply something that puts money in your pocket, whether you're working or not. And a liability? That's something that takes money out of your pocket. That is literally it. It's not about some theoretical appraised value. It is strictly about whether an item generates positive cash flow or drains it. Bottom line, if it doesn't put money in your pocket, it's not an asset. Now, what's really fascinating here is how this cash flow framework completely contradicts the standard financial advice we've all been fed. If you look at traditional accounting rules, your primary residence is listed as an asset just because it has market value. But under the cash flow framework, your home is actually a liability. Why? Because every single month, it is pulling money out of your pocket. You've got the mortgage, property taxes, insurance, maintenance, the whole shebang. This is a huge mindset shift for a lot of people. A home only becomes a true asset when it generates rental income that actually exceeds all of those holding costs. This brings us to what's known as the cash flow quadrant. It basically categorizes the 4 different ways people earn their money. On one side, you have employees and the self-employed. These folks are trading their time for active income. If a freelance graphic designer decides to take a month off, well, the money stops. But on the other side, we have business owners and investors. And the real breakthrough over here is leverage. These individuals leverage other people's time and other people's money. They build systems and acquire assets that just keep generating income, completely independent of whether they physically show up that day. Building on that exact idea, the sources break down our earning potential into 3 very distinct buckets: earned, portfolio, and passive income. Earned income is exactly what you get from a job. It's highly taxed, and again, it stops the second you stop working. Then you've got portfolio income, which comes from buying an asset low and selling it high. Think capital gains from stocks or flipping a house. It's great, but it's speculative. But passive income, that is the holy grail. It comes from cash flowing assets like rental properties, dividend-paying stocks, or a profitable automated business. It is explicitly designed to keep paying you month in and month out, whether you roll out of bed or not. And here's where the math gets, honestly, almost aggressively unfair. Notice the stark contrast in how these incomes are treated. Earned income is penalized the absolute most. Between federal taxes and payroll taxes like Social Security and Medicare, it is painfully easy for an employee to watch 40% of their paycheck just vanish into thin air. Portfolio income sits somewhere in the middle, with preferential capital gains rates, but passive income, it's taxed the absolute lowest. The tax code actually actively rewards business owners and investors with depreciation and deductions because, from the government's perspective, they are the ones providing housing and creating jobs for the economy. To really conceptualize this difference, the text offers a classic, absolutely perfect analogy. Earning a salary is a lot like carrying buckets of water from the river to your house. Sure, you have water for the day, but guess what? Tomorrow, you have to wake up and make that exact same exhausting trip all over again. Generating passive income, on the other hand, is like putting in the hard work up front to build the plumbing. You construct the business system, or you acquire the cash-flowing real estate. Yes, it takes serious effort and financial education to set up, but once those pipes are laid, the water, or in this case, the cash flow, just runs automatically. So how do we actually go about building this plumbing? The mechanics are literally just the classic game of Monopoly in real life. Step 1, you acquire an asset, let's say a little greenhouse. Step 2, you collect the rent, the cash flow, from that asset. And here's the crucial step 3. You absolutely do not spend that cash on liabilities.
Instead, you reinvest those proceeds to buy bigger assets, eventually trading in 4 green houses for 1 big red hotel. This snowballing, compounding effect is the exact mechanic behind real-world passive wealth. You continually redirect a portion of your income right back into rental properties, dividend stocks, or automated businesses.
As you start acquiring these assets, the sources detail some advanced strategies that, frankly, feel like a legal cheat code. A prime example is cost segregation. Now, normally, commercial real estate is depreciated super slowly, like over 27.5 or 39 years. But with a cost segregation study, investors actually use engineering to reclassify specific components of the building into much shorter depreciation schedules. This brilliant strategy accelerates tax deductions, allowing property owners to legally unlock 4 to 8% in immediate tax savings. It drastically reduces their taxable income right out of the gate. Let me break down exactly how that works in practice. Instead of treating the whole building as just one giant, slow depreciating monolith, the IRS actually lets you carve it up. Things like carpets and specialized lighting, those drop to a rapid 5-year schedule. Your office furniture shifts to a 7-year schedule. Landscaping and paving are recovered over 15 years. By front-loading all these costs in the early years of ownership, real estate investors create these massive paper losses. And those paper losses shield their actual positive cash flow from taxes. So they're making money hand over fist while legally paying a fraction of the taxes an everyday employee would. Okay, then there is a strategy uncovered in the text with a seriously morbid name: buy, borrow, die. Sounds incredibly intense, right? But here is exactly how it works. First, you buy assets that grow in value over time. Second, instead of selling those assets when you need cash, which remember would trigger a bunch of capital gains taxes, you just borrow against them. The loan provides you with tax-free cash to fund your lifestyle, all while your actual investments continue to grow and compound in the background. Finally, you pass the assets down at death. This often magically resets the tax basis for your heirs, effectively wiping out the capital gains tax entirely. It is quite literally a masterclass in letting your money work for you indefinitely.
Understanding these kinds of strategies highlights a critical, massive divergence in the order of operations between different classes. Think about it. When the middle class gets a raise, what do they usually do? They tend to immediately buy liabilities: a bigger house, a luxury car, a nicer wardrobe, and they often mistake these things for assets. But this just traps them in more debt and forces them to work even harder to maintain that new lifestyle. The rich do the exact opposite. When they generate income, they buy assets first. They use their money to buy real estate or businesses, and only then do they use the cash flow generated from those new assets to afford their luxury lifestyle.
So what is the ultimate goal here? According to the sources, it's about totally redefining your financial finish line. Financial freedom is not about hitting some specific, massive salary number. Instead, it boils down to a highly specific mathematical equation. You achieve infinite wealth the exact moment your monthly passive income from your assets exceeds your monthly living expenses. That's it. Once you cross that specific threshold, you are officially out of the rat race. Your assets are now fully funding your life, meaning you only work because you want to, not because you need to. Which brings us to the absolute core thesis of this entire explainer, a quote from the source material: "The rich don't work for money. They make money work for them." The text argues pretty convincingly that every single time you put your money into a liability, you are essentially sentencing yourself to more labor. But every time you put your money into a cash-flowing asset, you're actually buying back your own time. Your money basically becomes your hardest working employee. It works 24/7, never asks for a raise, and doesn't require a salary, all to generate more wealth for you. As we wrap up today's explainer, I really want to leave you with a thought from the text to ponder the next time you make a financial decision. Knowing that true wealth requires a complete shift from chasing earned income to acquiring passive cash flow, take a hard look at where your time, your energy, and your money are going right now. Ask yourself, what new assets are you building today? Are you just waking up every day to carry buckets of water, or are you finally starting to build your plumbing?